Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and KWBY, and again on Saturday morning at 9 on KATX and KWBY as Angela Robinson joins Terry Slavens to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
And welcome in to Life Planning 101 right here on KTX. KWI, Terry Slavens with you on this beautiful Monday morning. And we're joined today not by Angela Robinson, but we have the son and father team in here this morning. Good morning, gentlemen.
Good morning.
Good morning.
We have lots to talk about, and we know when we have Aaron in the house, we're going to talk a little bit about the market.
Yes, this is what today is all about, is about the market and how we look at it in 2019. And I think regardless of what you did in 2019 and how you were invested, you're probably pretty happy. You know, some people are going to be a lot happier than others, but it was a very strange year where everything made money.
Yeah, it's unusual when everything makes money, but you go back, we're in the election year once again, you go back to 2016, and when Trump was elected, a lot of people got skittish, but man, what a run it's been since he's been in office.
Yes, it has. It's been incredible, and a lot of it is, lowering taxes, lowering regulations, trying to put companies in a position to make money, giving people hope. It's been a great ride.
Yeah, I think for the first time, I know since 2000, actually 99 is when it started, but since that period of time, the Fed has changed direction so many times that it's really hard for corporations to find direction and feel good about the direction that the Fed or the government is leading them down. And this is the first time we've actually seen since that period of time that they're not in there changing the Fed rates every 30 days to 90 days to 6 months. And when you don't have direction, you don't know what your profitability is going to be or what your margin is going to be or what your loan rates are going to be. And that's really hard for companies to expand. So I think that's probably, to me, is one of the things I've seen that's helped as much as anything is the government not changing those Fed rates every 30 days to 90 days.
That's exactly right. We saw it at the end of 2018. It seemed for the first time the Fed was actually taking pointers from what the market was expecting instead of vice versa. Usually the Fed has two mandates, which is inflation and employment. And, the market told them what those expectations should be. And the Fed listened. It's the first time ever, so it's definitely a change of course for them and is a very good one.
Always good when you get the Feds to actually listen.
Yes. Yeah. I mean, you could hear it in their speech. It was 1 week. It was, we're going to do this regardless, and then the next week said, never mind, we're going to be data dependent. It was that drastic of a change. And don't you want the Fed to be data dependent every time?
Right. Yeah. That's because as consumers, we have to be data dependent.
Yes.
We don't have the luxury of just saying, I'm going to do this.
That's exactly right.
And try to do a man-made swing in the market or in the economy.
That's exactly right.
That's true. And people don't know what the Fed really does or why they do it, so they have to trust our government to be doing the right things. And that's not been a real, winner, I guess you'd say, over the last 20 years. But now it seems like they are finally listening, and I know it makes the banks feel better about loaning money. It makes people feel better about borrowing money because they know what those rates are going to be, because it's hard for anyone to make profit, if you don't know what it's going to cost for money. Yeah. And the only negative to the low rates is our money markets and our short-term money and long-term money, income
CDs,
vehicles.
Stuff like that,
they're hurt a lot. But if you go back 100 years, we really didn't have high interest rates until the 70s. Rates were always pretty much lower, maybe not quite as low as they are now, but they were still lower than what they were for years and years that we saw, but 4 and 5%. So
what Volcker really did in the mid or early 80s, it changed the averages of what interest rates were forever, and it just them way up because we got high double digits yields in the 80s, and he did that trying to squash inflation, and he did a great job, but it skewed what interest rates really are long term.
I say that about the gas prices. There's got to be a happy medium. We don't want to pay $5 a gallon for gas. $1.50 a gallon is probably too cheap. I mean,
Yes.
That's just the fact of the matter. There's got to be a happy medium on these rates. I mean, your interest rates, 12, 14% that we saw back in the late 70s, early 80s was probably not good.
No.
That's right.
At all, unless you were the person that had a lot of assets and no debt. Which is very few people.
That's right. Consumer needs really need to keep pace with inflation. And once consumer needs like gasoline start to outpace inflation, then we start looking for other means. If gasoline's too expensive, we're either going to be buying smaller cars or we're going to find a different type of transportation. Uber. How do we get around that we're not having to pay higher and higher gasoline prices that are way outstripping our income? So that's a very good point.
Very good.
But looking back last year, I said it was an incredible year. Everything made money. And I want to kind of give an idea of how we look at the market and how we invest. I've said this on here a lot of times, but really earnings don't matter in the short term. Profit margins don't matter in the short term. None of that stuff matters. If we're looking out at a day-to-day basis or a minute-to-minute basis, all that really matters is what people are buying and what people are selling. So that's really the only thing we look at in the short term. We're looking at this fear and greed. If people are buying everything out there, they're being greedy. And if they're selling everything and the market's going down, they're being very fearful. And today we can get a great gauge with the tools that we have of what we're buying and what we're selling. Not us as a company, but as a country, as a world. We can see that. And really, if you go back and look at 2018, in the fourth quarter, the market dropped 24%. That was an incredible fear fact. Everybody just dumped the market at one time, and it was maybe the day after Christmas where the market really turned around and it never slowed down. So we were looking at this, and the fear trade, people buying, when I'm talking almost all stocks right now, but people were buying into safe stuff, utilities, healthcare, real estate, things that are almost recession proof that people need every single day. And that dominated the entire market, even up through the fourth quarter, or up through the third quarter. These safe investments made more than the market. If you looked at very low volatility investments, they were up 20% versus 15% for the market. That's incredible. Gold made almost 20% during this time. Long-term bonds were almost 20%. It was incredible. People were scared out of their mind. And why? From an economic perspective, things look good. The majority of our economy is driven by the consumer. And everybody has jobs. We have record low unemployment. The middle class, their income is growing like crazy. It's growing faster than it has over the last 4 presidential terms, but 2 presidents. Things are looking good for the consumer, and that's 70% of our economy.
Well, good stuff here on Life Planning 101. We need to take our first break, and we'll come back with more right after this. Segment 2 already, Life Planning 101. Jim and Aaron Kennedy with us this morning, and we're talking market news. Good morning again.
Yes. Good to be back. Looking back, all the way through the end of September, what was the market doing? And fear was what was pushing the market higher and higher. The safer you were in stocks, the more money you were making. And it was incredible. Looking back, and no matter what kind of research you do, you don't see that a lot. If stocks are doing out of this world good, bonds are not doing good. We're expecting interest rates to go up for the Fed to slow that down, like we were talking about earlier. So bonds are usually doing very poor. Gold is doing very, very poor. Any of the safe havens are dragging behind, and that just was not the case. And it was actually fear pushing up the entire market from quarter one to quarter three. I think Dad likes to tell a story about why to be invested in stocks and what stocks to own for the long term, not as a recommendation, but why to hold certain stocks, whether it's toothpaste or gasoline or all the things that you use on a daily basis. We're still going to continue
soap are
using.
good for you.
Yeah.
Yeah.
I think the lesson to our, the public audience out there is the fact that emotions can be really good, but they can be really bad, and I remember back in the 90s, and a lot of you out there listening remember this, when the market was it went on for 10 years. It didn't look like it was ever going to go down, and tech stocks were just going up and up and up and up. And I used to do a lot of seminars, and had one particular seminar that, is right at the end of around 98, 99. And a gentleman stood up and asked me, he says, "What can you make me in the market, And I said, well, what we go by is just market averages. And he announced very loudly that if we could make him 20% a year, that we weren't needed, by him. He could do it. He could do that good a job by himself. And I said, well, you probably don't need me then, because a lot of what we do is not just helping people pick investments, but it's also managing your emotions to know what's going to happen, because no matter how good things are today, they will go down. The market will go down, and everything comes back to average. If you look at a body of water, you could have the flood rain coming down, the lake's going to rise, but when the rain stops, it's going to go back to average, and so it's going to come back down. And we just don't know how much it's going to come down and when it's going to come down. So, of anything that we hope people hear is they need professional help as to how to manage their risk in their portfolios, because this emotion really drives people to do things that they wouldn't normally do. And you take the price of gas, for instance. People go out and buy a larger car because the price of gas is down. As soon as it goes back up, they found out they can't afford that car because the amount of what gas prices are, and you see a big sell-off on large vehicles, and then you see them go buy smaller vehicles. When if they'd have bought the right vehicle to start with, they could have been saving money and be able to afford the vehicle when the price it goes up. And I think the same thing is with our incomes, our expenses. When you need money down the road, you want to have money there, and you got to have money that's set aside that you can spend that doesn't take a loss in the market. And we're sure not telling you to get out of the market, but we're telling you that you need to manage your risk and your emotions to make sure that you have what you need when you need it. And that's what's so important.
It absolutely is. We talk about discipline all the time, of having your plan, getting your risk right, staying disciplined. Last year, 2019, we had this wonderful market, but there was more money being pulled out of out of stocks and going into bonds than almost any time in history. It was one of the top times in history that people exited the stock market. And the S&P, if you reinvested your dividends, you made 31%.
Wow.
The bond market, it made a little bit over 8.5%, which is nothing to sneeze at.
Yeah.
That's a wonderful return. But if emotions got a hold of you and you decided to exit, you missed out on a lot of returns. And what is it? There's a reason that the average investor makes 2%, and that's because they let their emotions get a hold of them, and they're looking at what's happening today instead of what's happening tomorrow and the rest of our lives. If we only had one day to trade for our entire lives, maybe that's the way to do it, but most of us don't. We still got 30, 60, 80 years left of life going. So we need to know that. We need to know that in the future, things are going to be better and more exciting, more technology. We're going to have a better life in the future than we have now.
And I think people need to remember, too, that, when you retire today, and people are retiring a little bit later in life, past 65, maybe 70 or even later. But look at the longevity. You're retiring for sometimes as many years as you worked. And so you really got to be careful about how you invest your money. And a lot of people will run out there and become very conservative all of a sudden at retirement because they're not earning a paycheck anymore. That could be the biggest mistake they've ever made, because if you take what the bonds did this year, 8%, which is good, you have to think how bonds work. Bonds, you buy a 1 year to a 30-year bond. Well, when that bond matures, it doesn't matter whether it made 8% this year or not. It's going to mature at what the rate of return that you bought it at. Right. So if you bought a bond at 3% and you kept it for your lifetime, you didn't make 8%, you made 3%. And so, but you have to keep it for it to make that kind of return. And that's the kind of help you have to make good decisions about your investing, because people look at that 8% return thing. Well, I'll just put money in bonds. Just like they look at the 31%, just put money in stocks. And it's a very dangerous mode to get into, because you can think, well, why is my account going down? And the fact is, everything comes back to average.
Everything comes back to average. That's exactly right. That's why you can't let these emotions of fear and greed just take over, because we see it in the market. We track it on a daily basis, what people are doing. Are they getting super greedy? Are they looking at 31%? Or are they are getting very fearful and looking at bonds? We track it and we take advantage of it, and we take advantage of the people that are messing up.
Well, let's go ahead and take our final break, and we'll come back and wrap this segment up right here on Life Planning 1 on KTX and KWBY. Final segment already, Life Planning 101. We're talking market news today. Aaron and Jim are with us. Good morning again, gentlemen.
Good morning.
Good morning.
We had a fantastic 2019 and wanted to kind of go look at what to do in the future. Again, we can't predict what's going to happen. And, if you look at the stock market as a whole right now, it's a little bit expensive. If you're looking at any kind of price multiples or anything, it's expensive. But, 2019 earnings went down. So even if stock prices would have stayed the same with lower earnings, they'd have got more expensive if you're trying to value it on earnings. 2020, we're supposed to have good earnings growth. I think consensus out there is over 9%. So if you have 9% earnings growth, as long as stocks don't go up 9%, things should be getting cheaper. And that's good. But that's one place that I would be a little bit leery of, just the price of the market. But, good earnings growth for 2020, that's what we're anticipating. You still got your dividend on top of that. So it looks like it's going to be a decent year in the market. Can't predict what we're going to do, but things are looking like it should be good. But going forward, I have 3 things to do. We got the 3 Ds of investing, and that is be disciplined, at all times be disciplined. Don't chase things. Whether the market's going up, don't chase it. If the market's going down, don't chase it. And stay diversified, because we are all emotional behavioral investors. And if you stay diversified, you're going to have something in that portfolio that's working really, really well. And if that's what you have to hang your hat on, to feel good about being investing, that's great. You just don't want everything in one type of investing, because you want things to be working, something in there to be working at all times.
What's the old adage, don't put all your eggs in one basket?
Yes.
Yes. Very true.
You hear that all the time, but see it the other way all the time. Especially we see that a lot with people that have company stock.
Right.
And that's so difficult, because if it's the company that you're working for, you think, well, I have a hand in what this company's going to do, and I helped build this, and it's so hard for them to turn loose of their own company, whether the owners or employees. So we see lots of portfolios with the majority of their money in a single stock.
And we may talk a little bit about the process that we use in our firm, because I think this is really important. You have to figure out how much money you need. for your income needs. And if you took that and looked at it as a bucket of money, how much do I need to have in that bucket for the next 12 months? So it doesn't matter what the market does, goes up or goes down. I've got my cash money. And then what if the market does go down? Well, what happens the next year? Well, you should have a second bucket that says I'm going to have 2, 3, 4, 5 years worth of money set aside should the market go down. Because if it goes down, let's say that 24% that it did in 18, the end of 18, we don't want to be pulling money out of that because we'd be losing 25% of every dollar we pull out. So our process is we have a second bucket that determines based on a person's emotions, their risk, their discipline, their needs, a lot of different things. You might need a new vehicle. You may need repairs on your house, but you've got a bucket that describes what this money is invested in so you can get to it without taking a big hit from the downside of the market. And then your longevity bucket, the third bucket, is money that I'm going to need over the next 10, 15, 20 years. So let's say I'm 65 and now I expect to live to 85. Do I want money sitting in a money market from now to 85? Do I want money sitting there that's earning 3 or 4%? Or would I like to have money that's earning possibility of what market returns are, which again depends on your risk, but 8 to 10, 6 to 8, much better long-term returns than taking that money and risking it all. But you've got to have money to live off of, and that's so important. And really, I talk about retirees, but this is important for everyone because we all need to have that emergency bucket. We need to have a long-term bucket, and we need to have a cash bucket, which we call a now bucket. What do I need right now? I think that's very important. And again, that falls back to what Aaron was saying about the discipline. We got to stay disciplined with our buckets, and that determines our risk, which determines what portfolios we put the money in.
It is absolutely so important. There's a rule of 72 out there that said this is how often your account should double. You divide whatever your return is by 72. So if the market makes 10, if you have 100,000 in 7 years, it should be 200. 14, it should be 400. 21, it should be 800. And 28 years, you should have 1.6% or 1.6 million. So if you look at what the average investor does, is 2%. The average investor doubles their account every 35 years. So instead of taking your 100,000 and taking it to 1.6, it takes you even longer to go from 100 to 200.
Right.
And you know why? Because we're investing with our emotions. We get scared. We get fearful. And it's so powerful. And I can stand up here all day and say average investor 2, market 10, and it won't mean nothing. We can't even fathom the power of the market. And you can't get that power unless you learn to control your emotions investing or have somebody there to help you control those emotions. It is so important.
Got about 60 seconds left. Closing thoughts?
Well, I got one closing. Funny, maybe think about when I was a kid and got my driver's license. I could go to Brownwood over there and buy gas for 18 cents a gallon. So if we didn't invest that money, I would be way underwater and couldn't afford to even own a car, much less buy gas. If I didn't grow that, because go back 50 years ago, we need that money to grow so we can continue buying the gas. So the little things that we don't think much about turn out to be the big things because that's what gets us from point A to point B. Yes. And so. And
you would be heart healthy though. You would be walking everywhere.
That's right. So,
there's a payoff there.
There's a payoff.
Yeah.
Gotta stay positive. There's gotta be something.
So I think that the outcome of that is just get help. Don't try to do the job alone because it will come back and haunt you.
Well, there's absolutely no one size fits all when it comes to investing.
That's exactly right. Everybody's an individual. We all have our trigger points of what's good and bad. You just need some help to figure out what those are.
All right, gentlemen, always a pleasure here on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and KWBY, and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Advisory services offered through Smart Money Group, LLC, a registered investment advisor. Securities offered through Calton & Associates Incorporated, member FINRA SIPC. Kennedy Financial Services Incorporated is an independent of Calton & Associates Incorporated and Smart Money Group, LLC.